Welcome back to episode 16 of VW Exchange. Super excited to be with you all today. We have had 2 weeks of stories to catch up on, so full docket today. Excited.
Yeah, we're gonna jump right back into it. Happy to be back. Um, so we'll start off with a little market update. Recently, inflation data just came in today, actually. This is August 12th we're recording. So inflation held steady at 2.7%, um, kind of around expectations, nothing too crazy. And something notable to kind of take away from this is that prices were steady or even fell in a lot of the most common categories that consumers spend the most money on. So that's shelter, that's energy, that's groceries. So that's a good sign. But on the other end, um, yeah, there was a quote from Alan Detmeister, an economist at UBS Investment Bank, who said that there is a sign of some tariffs beginning to pass through, and this is in, say, furniture prices, tires, and pet products. So that's one end of it. So we can kind of jump into that if you want, Adam.
Yeah, this seems to be like a lot of the themes that we've talked about previously of oil prices and that, not being a big driver of inflation because we've seen a lot of supply and less demand, and so that's happening. And I think that groceries are another one that is something that is a physical asset that just hasn't gone up in value the same way a lot of these digital assets are doing and a lot of service-based things are doing. But I think that's something that we will see, and which I think that this UBS guy is right to point out is that a lot of these products that are more exposed to tariffs, like furniture, tires, whatever it might be, that those are ones to keep an eye on. But I would expect this to be worse as far as just your normal, even like clothing. I would expect to be in here as something that would be of note at this stage, but I guess not yet. So something definitely to monitor. But maybe I'll pass this to you of like, what does this mean? We keep talking about rate cuts. And if that's a possibility, how does this change that outlook, if at all?
It's I feel like it just adds to the fire. It's just a tough situation, but I think that the fact that overall inflation was steady is just continuing that argument for actually cutting rates. It seems like it would do a lot, and we can talk a little bit about some of this job data that came in as well, and Trump threatening to, well, not threatening, he did fire the head of the Bureau of Labor Statistics after a pretty bad reading. I think it came in around 73,000 jobs added, when there was an expectation of around 115,000. So when the labor market really is starting to take a hit, or I mean, we'll see if this is maybe as Trump would say, it's not real, but if this number is practical, it just adds to that argument.
Right. And I think that 73,000, I mean, that was obviously under expectations, but what I thought was concerning and kind of shared Trump's concern, though I don't know that this was the right way to handle it, was the downward revisions in the previous 2 months. So I think that was June and May that we saw the downward revisions were. So if we're looking at this chart, we have it kind of showing the month by month of the change in non-farm payrolls, and that these two got revised down to basically zero, that these are hovering around like 10,000 jobs added, and to have them where they were at, 250 or well over 100, that's concerning. That makes you question the validity of this data that they're putting so much time into it. And obviously, I would say that these people certainly have a process, and I understand that people are filling out this survey late and they want to, do the best they can to put an accurate picture forward. But it is concerning when people are making really big decisions over those moves just to find out a month later that, oh wait, that number was way off.
Yeah, I always find this stuff so difficult to even wrap my head around, like how we have a country with almost 400 million people, and trying to survey the exact number of jobs that come in a given month is an incredibly challenging task. And I do want to cut them some slack, but also see the other perspective and say that, it can be pretty harmful if you have incorrect estimates. So that's something else. But I think when you kind of look around and you speak around and you just see what's going on in the overall economy, especially with new graduates, and you see the struggles that they're having. I do think there is an issue in the labor market right now, and cutting rates would create some relief there.
Absolutely. Absolutely. And I think that there's a big story here too around how unbiased our institution is going to be able to be, especially under Trump. And I think that we've seen that with the Fed, and we have a new Fed chair waiting in the wings. Forgetting his name, but someone who's certainly going to cut rates if Jay Powell doesn't. And I think that this is kind of another example of firing the BLS head of it kind of, I don't know if we had better trust now or with this new head, because I honestly think that we probably had it better in the past where there wasn't kind of the threat of what I would see as if the BLS head doesn't post that we made enough jobs this quarter that maybe we cycle them out for a new guy. So I think that it's all my confidence is kind of being eroded in some of this information.
Yeah, and even if whatever it is, it's just to the average American who reads this and also sees concerns about protecting the independence of the Fed. It just isn't a great look, and you just wonder maybe how it's going to play out, or maybe, maybe this will be better. I don't know. We'll
Right.
see.
We'll see. Maybe we can pivot to this Nvidia story. I think that this is something that we'll definitely get to a bunch later because we keep talking about AI, but that this was a major deal that happened, and since you threw this on the script, I'll let you kick it off.
Yeah, so I just thought this was something important to note. Wall Street Journal just came out with an article kind of talking about Jensen Huang and his influence on the president. And we know that Trump really wanted to keep AI in-house and really push some pretty restrictive tariffs on U.S. companies that would import or export with China, especially in this AI game. Um, but Jensen Huang might have actually done something in the long run that we're going to look back on and be like, wow, this was incredibly impactful. So he basically told Trump that, ship sales to China, putting restrictions on it would force China to become self-reliant and create their own chips and start to push the game on their own end, um, which could have been really detrimental because right now they're very dependent on us. And Jensen said, you know what, like we got to keep them relying on us. We got to keep them buying from us, and we want to be the ones leading the way in this tech drive, and we'll let them make their own things. But at the end of the day, they're going to be um, buying parts and chips from us. So something that I feel like wasn't getting as much attention as maybe it should. I think this is going to be something you look back on and be like, wow.
And I think the press in here is super interesting also of that Jensen Huang as the chief executive trying to make the right decisions for shareholders. And in this case, in the Trump world, that is certainly trying to make your pitch from a political kind of point of view of, how is this benefiting the US? How is this damaging China? And the agreement here is also super interesting of that Nvidia is going to be able to ship out its inferior chips, not even the Blackwell, the newest thing. It's these old H20s that Trump is letting Jensen export. And in exchange for the export license, Nvidia is saying we're going to pay 15% of all our revenues that come in from this China trade, and we're going to pay it to you, President Trump. That is insane, and I'm obviously a good deal for the U.S. that they were able to pull this off, but something that I think is bizarre if we keep seeing this, and I don't know if this is a good or bad thing, but obviously is a revenue stream for the U.S. So certainly something to be said for that.
Yeah. I don't know, he's become like this really global figure and he's leading this race and it's really cool to see kind of what he's doing.
for sure. Um, and then maybe it's a good time for this story too, where we kind of separate out, and this can be where we kind of get to the crux of the theme that we're talking about here, is that there is a big shift here, and we have Nvidia who's about to sell a ton of chips to China, and less hamburgers are being sold to Americans, and fast food traffic is down, eating out's becoming more expensive. Not really sure what this all means yet, but it certainly seems when we talk about the Main Street and Wall Street theme that Main Street is showing some signs of hurting.
It hurts. I mean, it hurts me. I was at, where'd I go? I went to Kava. I got the most basic bowl you could possibly get, and I spent like $14. It's just, it's a lot of money. And Chipotle bowls have gone up. Like, I think there was like, it used to be like $5, $6 less than a decade ago. Now it's 11, 12. So prices are going up a lot. Everyone's feeling it, but kind of the theme here is that lower income individuals are kind of pulling back the spending the most. Um, and this is kind of to an extent who some of these restaurants are catered towards in a way, but it's it's like fast food is becoming a luxury now, which is a very a very odd concept.
And it's sort of interesting too that, and I'd be curious if this theme plays out, but we've seen bad earnings from Chipotle, Sweet Green, not quite sure about Cava, but that some of these that toe the line of that they want to still sell to lower income people, and they want to also be able to show themselves as a quality product to pitch themselves to upper class people, that lower income shoppers are, I think, increasingly kind of pivoting toward as they tighten their belt towards the McDonald's, Taco Bell, etc. And that, there's more and more deals and there's more and more lower pressure on those prices, that we're seeing the $5 meal come back. And I think that is kind of what we're seeing read from the inflation data too, is that there's just very little pricing power that those firms are able to pull right now.
Yeah, really getting crushed. Those margins are really getting crammed. We're seeing people go back to the Lux Cravings boxes, and Taco Bell does a good job with that. But how sustainable really is that? What are the margins like there? It's not 100% working, and it's driving some traffic for the time being, but it's going to be challenging to get those prices down. Or what is it going to take at this point? This is kind of a larger theme that we're seeing. We talk about sort of the wealth gap a lot and the difference between top 1% and lower income. So maybe we could find something cool to talk about as a segue here. Let me see. Mm, I mean, something that I thought, so I said this to Adam earlier. There was this YouTuber, his name is Infronomics, and he made a really great video just kind of talking about um like the debt crisis and something we've been talking about a lot and how the only thing that's really keeping pace with the amount of debt that we're issuing is the stock market and the stock market's growth. And one of the themes that was discussed was just the difference between um like income growth versus S&P 500 growth. And income growth, for perspective, back in the 80s, 90s, it took about 20 hours of work to purchase one share of the S&P 500. Today it takes 200 hours of work. So there's a real issue there. Just that income growth has not been increasing at levels it probably should be, and how we're turning to the wealthy. And a lot of the tax revenue that's being generated is from capital gains. So I'll let you hop in for a sec, Adam, as we introduce this.
I've watched bits and pieces of YouTube. That stat also stood out to me when he was going through that graph. I found that. absolutely nuts. And I pulled this graph here at the bottom that shows, and apologies for listening on video, but it shows real personal income sloping down for, and this is going back to the 50s and 60s. And then we have S&P 500 over GDP and corporate profits over GDP and showing how those are increasing. So the main point here is that as real personal income has gone down and has real wages relative to GDP have gone down, corporate profits and the S&P 500 is going up. And that puts the government in a really interesting situation too, because as this video pointed out, and something that I didn't think about, is that the government's really relying on those capital gains from the 1%, and that they're not making a lot of tax revenue off of these workers whose wages are being depressed, who aren't spending as much, who don't have as much money in the stock market. But where they are going to make a lot of money, hopefully, is if these stock prices stay high and at some point people sell and pay that capital gains tax. But if that doesn't happen, then we're in a lot of trouble.
We keep going back to this theme, this debt theme, and it is like enhancing this wealth gap that we're sort of seeing because we are dependent on the rich getting richer in by holding financial assets in the stock market that shield themselves from inflation and from monetary debasement and anything else that um, lowers the value of currency over time. So we are very dependent on the tax revenue from them, and we have a real debt problem. And not that this is necessarily saying that if stock market crashed, that the entire US would go under in a day, but that this is something that is being incentivized and something that our economy is almost becoming dependent on.
Right, right, and it's another issue of kind of how we kind of maintain a broad dynamic economy where the fast food providers are doing good and the retail providers are doing good because all those still really depend on this lower income group and they depend on really the masses and then the middle class, not even just the bottom to be spending money and for that to be circulating through the economy. But as we kind of see that the main way to create wealth is through, the S&P 500 and being tied to these corporate profits and not being tied to just your wage. You have to have this capital income as well. That's going to be hard to sort out too, because I don't know what there is to reverse this trend. Um, so it's going to be a tricky spot, but the government maybe is in a situation to use that revenue from 1% to maybe help broaden it out, but I don't even think that is a long-term strategy either.
Yeah, really pressed for capital. And I one solution, I don't know how much you've looked into this, but I've heard some opinions being thrown out about the Trump accounts. So any child that's born in the next, I believe, just 4 years, however long he's in office for, is going to have $1,000 put into the S&P 500 under each child's name and can't be touched until you're 18. But basically, the idea is here that you're teaching financial literacy, and a lot of billionaires and the top 1% can actually donate to certain individuals and say they go into a neighborhood and say, you know what, I want every kid in the school district to get another $1,000 from me into their S&P 500 accounts. So this is another sort of strategy that has been talked about and a lot of ideas circulating it. Of course, it's not going to be a cheap endeavor, but maybe this is a step in the right direction. This is if we're going to be completely dependent on the SP 500, maybe at least everyone can get involved in it. But I don't know. Any thoughts from you?
I think that that's true, and that is part of the problem, that making sure that everybody has financial literacy and making sure that people are getting in the stock market as early as they can. I think that another part of the problem, though, too, is just the education piece of this, and that, not everybody has the ability to go to these top universities and get this highly technical training in software engineering or AI or any of these things that are going to drive the digital economy in the future. So I don't know the best way for that to broaden out. If those are going to be, the best source of high income jobs and the way to, accumulate the most stock of whatever AI startup you work for, I think that it's hard for me to see in a short time frame of where we get those educational tools to the masses in a productive way. Because certainly there are efforts to do that, but at the end of the day, that has to happen. That has to happen quickly. That these people get these skills, as soon as they can, because it's easy to be left behind in terms of whatever quantum thing is coming next.
I don't know. I totally agree with you. I'm just trying to think like, why hasn't YouTube done this yet? I feel like in a world of social media where you can post anything online, why would this not already be a thing? Why are people still going to college? I feel like you can learn anything and more with AI. Like you can use ChatGPT and ask it anything, and then you can watch a YouTube video on the side. I don't know.
It's true. I don't know that I'm disciplined enough to restrain my YouTube
Fair.
access away from the reels and the other junk to the productive stuff, but we try. That's why we're putting this podcast out there. We hope we hope it's finding some ears and providing some help. But I do think that there is something to just be said for, the mentorship and learning, besides other people at the same time and that in-person element. But also have to note that that is just a way more expensive way to learn than the way that you said of using YouTube and ChatGPT. So, in trying to make education as accessible as possible, I think that you also point out something really good that these AI tools are also a way to do that. So that's a hopeful note.
I don't know. There's a ton of potential there. We'll see where it goes, but as you said, there's something about that structure of school that I think is irreplaceable, and actually having a real physical teacher in front of you. I don't know though. We'll see.
We will see. And maybe to close out, this is kind of the same story. I wish I could close it on the hopeful note, but we could probably find a hopeful conclusion here too. But this is also kind of following, what's going on with those mega cap stocks and how the market is kind of made in a different way than it is now. And the article, I think, takes a very interesting approach if you got to take a look about the differences between tangible assets and intangible assets and how our economy today is really focused on these intangible assets and how those you're just able to get a much better return on what you put in. And that as a consequence, that also leads to some of these other, we could say negative effects, or we could just call it, the new reality of having a concentrated stock market, having a more volatile stock market than we've had in the past, and having valuations that look higher than what we've had in the past. So, and just wanted to kick it to you if you have any initial reactions.
I mean, it's interesting. This is the new world we live in. We're in a digital software world. It's not the era of the physical. It's a weird thing to grasp, but something that I thought was really cool was just kind of like the accounting treatment that the article mentioned. So, of course, if you have tangible assets, a lot of these physical investments actually accumulate. Um, so, but if you have an intangible asset, it gets treated as an expense typically, unless they're acquired. So, it's kind of creates this disparity between book value and like reported earnings, and it makes it appear a little bit more expensive, but it might not actually be as expensive as you think. So I know everyone talks about super high valuations all the time, and of course that is true. And there are other factors that go into it. It does seem like they're still expensive anyway, but something adding a little bit of pressure onto it is also kind of this accounting issue, which is really weird to think about.
Shout out to the Brown economics or accounting department for their knowledge. And I think that was also interesting to me as well about that we don't really factor in when considering the price to earnings multiple of today's companies versus historical companies with the fact that, with them being mostly digital, that it's so much easier to scale and, make sure that your product gets out to, we saw what was that AI company that we looked at last time?
Oh my gosh, was it lovable?
Lovable, yes, about just how easy they're able to get to 100 million annual recurring revenue. That's something that you couldn't do 20 years ago. So maybe that helps justify some of these higher P ratios. And also just taking into consideration too that, once you can kind of create this software ecosystem like we saw with Apple and how, when we text each other it has blue text, and if you're not on it, you have green text and you look like a scrub. Or there's iOS and there's iCloud, and that it's all integrated to keep you on the system. So if you're the first mover on this, you have a real winner take all advantage. So I think that that's something that's super interesting, but also leads to a concentrated stock market because, if you're the winner, then you're one of the big fish, and that's also going to create, a really volatile stock market, and there are other consequences that come off of that. But regardless, I thought that it was interesting that there are just some structural reasons of why today's valuations are less correlated maybe with what we see in the past.
Yeah, and maybe it's not as scary of a thing as people think. Maybe this concentration isn't going to be the worst thing. As you said, someone, is going to win, and the winners are going to really have a lot of influence. Not only that, they're also going to acquire a lot of smaller companies. You see Nvidia acquiring everyone who does remotely what they do. So there's a lot of consideration there as well.
Right. And I think the last thing I would say too is that, with all these intangible assets, it does make it so that you should really be asking questions about, what is this company doing, and is the investments that it's making into some of this digital infrastructure as valuable as they say it is, and as valuable as you're hoping that it will be in terms of their string of future cash flows or future subscription revenue, which we've seen from ChatGPT, but that path is not there for everyone. So I think that, taking a note of that is something that will be helpful too. Just because, when you're looking at a REIT, for instance, in real estate, it's really easy to value by trying to value those properties. But trying to value Google's AI business is going to be harder because all that is somewhere digital and in the cloud, and it's only useful as, the people who use it, right? So.
Yeah, if you're invested in Meta, do you trust that the company that you're invested with is giving $150 million to a 24-year-old to write code? I don't know.
And they
Maybe.
might be right because once the guy sets it up, you can blast it out to everybody and everybody. When you are, paying a construction guy to build something, you can't move that shopping center everywhere. So we do I do kind of see that this being scalable technology, that makes it more valuable and unique too.
Yeah, just those high fixed costs, and then you're smooth sailing.
That's right. In theory, we can hope, and I'm sure the government is hoping too, as we pointed out.
Keep those earnings coming.
But I think that's all we have today. We got through a good mix of stuff, and I think that these are all things that we'll come back to all the time. So interested to see how we build from here,
Laying the groundwork. Good stuff.
for sure, for sure. Well, thank you all for listening. Glad we were able to bring this to you, and we'll see you next week.
Take care, guys. Thanks for listening.